Today is Wednesday, July 12th. This is a review of the CPI, aka the CPI. And folks, I got a good one for you tonight. Let's begin with this. Today we got the CPI reading for the month of June, and it was pretty much plain vanilla. The cooks gave us just a little touch below expectations. The month-on-month CPI, the expectations were 0.3%. We got 0.2%. Same goes for the core CPI month-on-month. CPI year-on-year, the expectations were 3.1. We got 3%. Core CPI expectations 5%. We got 4.8%. We know that the majority of the inflation problem comes from the services sector this time around, unlike last year, where the majority of the inflation problem came from goods and energy prices. So when we look at the so-called super core CPI, which is basically services minus housing and energy, because housing and energy are not really that important, the reading is 4% year on year. If we look at Jerome Powell's favorite indicator, which is core services x housing, because again, housing is not really that important, it is down at 4%. But a reminder, all of these readings are being suppressed because of the base impacts. The base impacts already expired now. In the next reading, we have 0 base impacts, which makes the next reading really interesting. But here are the details. And my favorite indicator right now, because the majority of inflation is in services, is actually services less energy services. If we take that reading, it's up by 6.2% year on year. So the base impacts aside, we haven't done any real progress in defeating services inflation. And unfortunately, according to your beloved media propagandists and analysts, they've already declared victory. Inflation is over, it's done, it's dead, that's it, goodbye. But what they're not telling you is the majority of the drop that we got is coming from base impacts, and we haven't done real progress when it comes to services inflation. Here's the commentary from economist Mohamed Al-Arian. Take a look.
Right, so we've entered a nice period for the CPI headline inflation prints. I think we'll get around 3% today. I think it's going to be well behaved on an annual basis because of the base effects. But me and many others are going to be looking not just at core, not just at services, but asking the question, can you maintain goods disinflation? That's what has gotten us down here, particularly energy, while also starting to see services disinflation. That is the big question. I worry a little bit that people are jumping to the conclusion that goods disinflation will immediately translate into service disinflation. That's not what we're seeing in the rest of the world. So we just got to keep a really close eye on that.
So in a nutshell, Al-Arian says that don't assume that the disinflation that we've seen in goods will somehow translate into disinflation in services just like that. It's going to take more aggression by the Fed to see a response in services inflation. But what I would tell Mohamed Al-Arian is, we got another thing coming for us. We talk about energy inflation as it's a done deal, it's over, it's gone, it's not going to come back. I say you better watch your back. Look at the month-on-month readings in energy categories. We've been seeing a disinflation process. The month-on-month readings were negative, going all the way back since the beginning of the year. Yet in the latest reading, we see the month-on-month disinflation process in energy categories actually stopping and turning positive. Take, for example, gasoline. The reading was minus 5.6% month-on-month in the May reading. Now it's back to positive 1%. If you look at fuel oil, in the month of May was down 7.7% month-on-month. Now we're down 0.4% in the month of June. The bottom line is the disinflation process in energy categories is perhaps ending. We're now seeing reinflation in energy categories, which means we could see reinflation in goods again. Transportation costs increase higher, and as a result, we see goods inflation coming back into the picture. And that would be an absolute nightmare scenario. If you look at commodities, the month-to-date performances so far, you can see that the WTI has already scored gains north of 7.5%. We even see the gasoline RBOB gaining about 6% for the month. So we're already seeing the process of reinflation in energy commodities, which will be translated into inflation in goods in the next reading of the CPI. Not to mention the fact that we have not done enough progress in services inflation. And on top of that, the base impacts disappear in the next reading. In other words, this could be the bottom reading in the CPI. And look at what it did to the dollar index. This is a monthly chart of the Dixie. It appears to be breaking down. If the Dixie goes down, what do you think will happen to commodities prices? They will appreciate. including energy commodities. And that would be bad news for the prospects of inflation going down, bad news for those who say that we have a soft landing coming in the economy, bad news for the doves in the Fed and their allies who believe that the job is done, and bad news for the stock market. I shared this in the members video tonight. Since 22, when the Fed started raising rates and tightening the monetary policy, we have an inverse relationship between the Qs and the XLE, the oil ETF. The point being here is, we see the Nasdaq and the biggest names in the stock market appreciating in value when energy stocks lag or trend down. When they trend up, we see the Nasdaq, the Qs going down. In other words, the market rallies based on the prospects of disinflation and the Fed ending the quantitative tightening campaign. But if the dollar crashes and we see reinflation in commodities, specifically energy commodities, then we will see the XLE and energy stocks appreciating and moving higher. And this will mean that the Qs will take a leg back. And the higher the reinflation process in energy takes us, the lower the equities market will go. So all what we heard today in the media is, oh, inflation is over, we're back to the 3s, next thing you know, we're going to go back to the 2s, the job is done, the Fed should be backing off. But I've never heard anybody talks about the risk of reinflation. The fact that the dollar going down is good for reinflation, which will push energy commodities higher. And as a result, we will see a reinflation process in goods. Not to mention, of course, the wage inflation problem that we have in this economy. Here's Mohammed Al-Arian once again.
2 is that the service sector is less sensitive to interest rate hikes. You need to do a lot more on interest rates to get to the service sector as opposed to the goods sector. And then the third issue is wages. We got to keep an eye on wages. We don't want to fall into the trap of the UK, where the UK now has become an inflation process where wages are growing by 7%, with the private sector growing at 7.7%. And that's just a natural reaction to people's purchasing power having been eroded for so long. So keep an eye. Just let's not jump to conclusion. We've got to keep an open mind. You know, the Fed has made many mistakes on inflation in the last few years, and one of them has been not to look at enough scenarios. And we've got to keep our mindset open to various scenarios.
And what do we got today? The UAW is now formally beginning contract talks with the auto industry. In other words, if they don't get higher wages, they're going to strike. Yesterday, we talked about the prospects of reinflation in new car prices. Well, here's the evidence. The workers will be paid more, and they should. And companies will respond by raising prices for those new vehicles. And all of this is reinflation. We're popping the champagne because used cars prices went down. But it's only going down because new vehicle prices will go higher. Here's Al-Arian once again.
Bigger question, and that is what causes wage inflation? Is wage inflation a response to just rising inflationary pressures and the need for workers to be able to keep up with the cost of living, or is it vice versa? And I think, where do you stand on that? Because I think that's sort of key to understanding whether or not the Fed feels the need to knock the labor market down more.
You're absolutely right. And it is both. You can get to a phase where you are in the UK today where wages are both, where inflation are both fueled and fueling higher wages. Fueling higher wages is easy. People are trying to protect their purchasing power. They ask for higher wage increases. And if they're in the service sector, they have pricing power. Fueling is the service providers feeling that they can pass through the higher wages into higher prices and therefore fuel inflation as a whole.
So all of the people who say that inflation is over, we have a soft landing coming, that's actually called mass delusion. We have not seen the end of this inflation episode. We have never seen inflation going down in one shot back to the target. Usually we have a process of reinflation. Usually we have a process of inflation perking up higher again. And usually the reason behind that is an error by the Fed policy. Pausing prematurely, declaring victory prematurely. But right now the odds for a July hike is at 92%. So that's already in the bag. And they say because credibility. They paused, they said they're going to raise, now they have to raise. But that's it. That's the last one that they're going to do. Folks, we've been hearing this since November of last year. Oh, this is going to be the last one they're going to do. And they keep going and going and going. Why? Because they're not in charge. Inflation is. Now the odds say that in the September meeting, we're going to have yet another pause. The problem is, I just showed you, we're about to see goods reinflation because energy prices will move higher. Services inflation remains sticky. It never really went down in a significant way, and the base impacts are gone. The next reading could be absolutely shocking. And all of these hopes and dreams that the Fed will do one and done yet again, watch out, they could do one, another one, another one, another one. We even go as high as 50 basis points. They're popping the champagne now, led by, of course, Mrs. Braindead, who used to be vice chair of the Fed when she was known as Queen Transitory. Now she works in the Biden administration, and she came out today downplaying the chances of a recession hitting the U.S. economy and bragging about how inflation is lower than other nations. Will somebody pretty please remind her that rates are going higher and they're staying higher for longer, and we're about to see reinflation in the economy, led by energy, services reinflation, goods reinflation, base impacts no longer here. And as rates continue to go higher and higher and higher for longer, what do you think will happen to this economy with the insane amount of debt? Look at this. We know that credit card debt among consumers is above $1 trillion, and the interest rate is now shooting to the highest level since the 1970s, close to 21%. So the dollar goes down, we see energy reinflation, yet the consumer with these higher rates will get choked even more. That's going to lead to a stagflation crisis in the economy. And some in the Fed already know that. Take, for example, from Minneapolis, Neil Kashkari. Today he came out and he floated the idea of a new high inflation stress test for banks. Not only that, but suggesting that regulators could force weakened banks to cut dividends to make them more sound. Now, if inflation is dead, if mission accomplished, why would we even bother with a high inflation stress test? They know the job is not over. They know that inflation will make a massive comeback. The second wave is coming, and it will be the most brutal wave of this inflation episode. Not because it's going to be higher than last year's top at 9%, but because now the consumer is more indebted, because now the consumer is weaker. Now we have more systemic risk than before. And if rates will go higher in this country for longer, and we've been ahead of a lot of nations, what do you think will happen to the UK and the EU? Well, look at the private sector debt to GDP ratios. They're sky high, above 100% across all of these nations. As rates go higher, it's going to cost more and more and more to service this debt, meaning less and less spending in the economy by governments, which will cause a recession. The other choice is to raise taxes significantly higher, which will cause a political backlash. The bottom line here, folks, is this is not over yet. We have more twists coming to this story. And the problem is the Fed misguided us by downgrading interest rate hikes from 75 to 50 to 25 and then a pause. And of course, everybody rolled with this assumption. We saw a recovery in the equities market, a recovery in the housing market. We saw the aggregate demand in the economy kicking in. And now we see wages moving higher again, beating expectations according to the latest payroll report. So we have more and more inflation coming in the pipeline. And today was the bottom in the CPI. From this point on, higher we go. And it'll be really interesting to see how the Fed is going to respond, how the equities market will respond, how the bond market will respond. Most importantly, what are the prospects of systemic risk event as interest rates continue to go higher for longer? And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Higher!